Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn. Welcome back for our first episode in 2019. Mr. Geoff Gannon, how are you doing over there?
I'm doing great, Andrew. How are you doing?
I am doing great, as always. We hope everybody else is doing great. We're so excited to get back going with the podcast. Kind of took a little bit of a break into the end of the new year, and when Geoff and I were sitting here, I was like, I'm excited to get going on the podcast and fire it up and hear my voice. I'm sure everybody else is probably not excited to hear my voice, but ready to get going. Hope everybody had a great holiday season, and we are excited to be back. So for the first podcast back, I thought, since there's been a lot of market volatility lately, I thought that it would be a good idea to do an initial interest post, kind of review the ones that you do on the website. For people that don't know, if you are a premium member, Geoff writes initial interest posts all the time, sort of just like your first, your notes from looking at a company, right? So, I mean, maybe you could talk about kind of how you do it.
Yeah, that's right. So reading about the company, I read the 10K, things like that, and then I write up a article which basically says from 0% to 100% how interested I am in following up with this company. Yep.
And he actually put one up recently, actually today, on the website for Green Brick Partners. And if you do want to get access to that, you could go to focuscompound.com. And if you do sign up, use the podcast promo code, and that'll take $10 off of the subscription price indefinitely, as long as you do stay a member. And even better, for other people that don't want to pay, we do have a free section on the website now, which has content that we are going to stay consistent with, and it's great. All that is required is your email, and then you have access to all of those free write-ups. So one of the four main points that you hit on for the initial interest write-ups is, do you understand the business? Is it safe? Is it good? And is it cheap? And that's sort of your filters that you go through when looking at any sort of company to decide if it's a good, worth pursuing. And what's interesting is we do it in that exact order, right? Is it an understandable business? Is it an understandable business? If you don't understand it, you're probably not going to want to see if it's safe or good or cheap, right? So that's pretty interesting as well. So I'm just going to fire out these names at you. And we could kind of go through them. I don't know how long each name will take, but we could just kind of see where it goes.
Right. So with the exception of Green Brick, these were initial interest posts I did last year. Sometime last year.
Yeah, and because of, like I said, all the recent market volatility, maybe it's just a good time to, I thought, sort of revisit it.
Right, because the price might change.
Yeah, exactly. And at the end of every write-up, what you do is you just give, like, if you're 60% interested or 90% interested, is it really anything over 50% is good, or how do you typically think about that?
Over 50% means I'll probably look at it again.
Cool.
Yeah.
Cool. All right. So first one, USLM, ticker USLM, and your interest level was 50%.
Right. And it was that low, 50%, because of the price.
Okay.
I was interested in the business, but I wasn't as interested at that price. So USLM operates, owns and operates lime sites for the production of limestone and lime for use in things like water treatment, and steel uses it, and some other things like that. And limestone is used a lot in construction. And so the company is actually based probably not that far from here in Texas. And it's an industry that I like. So it's an industry that I like, and they have reserves that would last a really long time too. So there's sort of there's not a lot of competition in the industry generally because of the low value to weight ratio of lime, and so you don't transport it very far. I think they mentioned the 10K that they don't have customers outside of 300 or 400 miles or something like that.
What drew you to the company? How is it even an overlooked stock, or how did you come across it?
I don't know how overlooked it is. It's a few $100 million market cap. I had looked at it because of the industry years ago, and so I decided to write it up for the website because it just it has a moat, basically.
Sure.
That's why, yeah.
Do you remember what price it was trading at when you wrote it?
I don't remember the exact price. If you tell me the price now, I can definitely give you an idea of
let's see
how much higher or lower it is.
Let's pull. So it's at $70.73.
So not very different.
Yeah.
Not that different.
Mm-hmm. Yeah. If you look at a longer chart, the stock really is. You probably wrote up about it's ranged from $70 to $80. Pretty sure. So
and it would have been written up really close to that.
Mm-hmm. And you liked the business, but you did not like the price.
Yeah. I didn't love the price. It doesn't have it doesn't use leverage really, so it has a little excess cash for that kind of business. Usually, a private owner might put quite a bit of debt on that kind of business because it's pretty predictable.
Mm-hmm.
And at least when I was looking at it, probably it wasn't producing that close to capacity, which is the other thing. Because since the recession, a lot of those kinds of businesses haven't been producing as much as they could theoretically be. And like I said, it has very good reserves compared to a lot of times people are interested in things like oil companies or something as a natural resource company. Mm-hmm. They generally have fairly short lives in terms of how much their proven reserves would last. And this kind of company has very long, decades and decades ahead of it without having to invest in buying more deposits. Yeah, and I think I talked about in the article that I would guess that in 5 years, 10 years, 15 years, there will be fewer sites in the U.S. producing lime. And each site will probably invest more in being able to produce more there. And a lot of that has to do with just like permitting and stuff, like environmental things, stuff like that.
Why do you think that there'll be less producing it?
There has been less for probably almost 40 years or so.
So it's been a decline, yeah.
Yeah, CapEx usually goes into expanding existing sites.
Got it.
And modernizing them as opposed to building new ones.
I mean, it makes sense why it's declining then in regards to that.
Yeah. And I'd say that for about 40 years, the economics of the industry have gotten a bit better. And I don't know the exact number of how big USLM is, like if it's, I don't know, fifth or so biggest producer in the U.S., but the top 3 or 4 now control a pretty large part of the overall industry, so it's probably a little more rational that way.
Cool. So that kind of hits the point. Do you understand the business? Is it safe? Is it good? Is it cheap? Well, we don't know if it's necessarily cheap.
Right.
Cool. Next one, Residual Technologies, REZI, and your initial interest was 60%.
Yeah. Now, this one, do you have a price on it? Because this, I think the price did decline. So I did the initial interest post, I believe, before it was spun off from Honeywell, right?
That's correct, yeah.
Yeah. So we won't have an exact price on it, but I had an idea.
Yeah, so it's at $20.56.
Okay. So that is cheaper. I don't know if it's a 30 or 40% cheaper than what I expected it to spin off at or something like that.
Sure.
I don't know what spun off at, actually, the price that it did. But I would have expected that it would have been probably 1.5 times more expensive when it spun off than it is now. So this is a business which is a spinoff from Honeywell.
Yep.
It has sort of 2 parts, ADI distribution, and then it also has a business which is the products business for Honeywell. So some of this is actually the oldest part of Honeywell. Honeywell was one of the first companies ever involved in thermostats, and this company would be the part that's involved with home thermostats and things like that. So you probably have some products from this company in your home. They, as part of the spinoff, have a deal where they have rights to using the name Honeywell Home. And so it'll be things like it's everything from, humidifiers, dehumidifiers, fire and safety stuff, heating and cooling things, a lot of controls for that sort of thing. So thermostat's a really good example of the kind of thing that it would be.
Sure.
And then the distribution business is a little bit more for distributing for, say, someone who puts in security alarms or something like that. They also produce some things for which are produced under a brand name for some other companies. So like examples there would be ADT.
Sure.
So if ADT has some things that they install in your home, some of the actual devices there that they have, controls on things and stuff, will actually be made by Honeywell for ADT, and we'll say ADT, but it was produced by Honeywell for them. Same, I think, with Carrier and some other companies like that. And
it came up on your radar, obviously, because of the spinoff, because of the managed accounts.
Because of the spinoff. Yeah. So the interesting thing about this business is the parting gift, right? Mm-hmm. So Honeywell is a very old company, old U.S. company that has roots going back into the very late 1800s, and Honeywell as exists today is sort of the early 1900s. And this company, I believe, is going to be headquartered in New Jersey. Honeywell, part of the business is has a history in New Jersey. I guess Honeywell was formed from a few different companies in mergers, maybe 20 years ago or so. And some of them have roots back there. So, including places like the sites in New Jersey would have environmental obligations. And so they're sites where they had produced things that have significant cleanup costs, very significant cleanup costs. And so I believe at the time they spun this off, the expectation is for, I think I talked about $140 million a year that Residio will pay. So there are certain sites that spun off with it, and they have obligations under that. And so the interesting thing there is that that's a cash thing. It's a cash expense, and you can't deduct those expenses for tax purposes. So if I say like it's $140 million expense or something, it's $140 million in free cash flow that goes out every year. Sure. It's not just a pre-tax thing. So it's not like other expenses that would be $140 million. So the thing there is over time, they're not going to have new sites. So they just have to pay on existing sites. And it may be that some of those sites eventually don't require the same amount of cleanup, and that number goes down over time. So it trends down closer and closer to zero over the years. And I talked about in the article exactly how much that would just increase earnings per share, not through any kind of growth, but just if they were paying less and less to clean up. Because if you do the math, that amount of money is really big in terms of how much growth it could have. So like I looked at, okay, so say it takes 10 years or something like that. What's the percentage growth? And you gain a couple percent in EPS growth for a decade, just from slow trending down in that, if that happens. So, and I don't know if it will happen or not, but that's something for people to investigate and figure out. Mm-hmm. So it's very possible that you'll just have sort of automatic EPS growth there, and it's easy that the company could be undervalued long term if it turns out that those obligations aren't going to be permanent. Because the sort of way that the company would look at it, that I would look at it, that analysts would look at it, is sort of look at this year's results. And those results are going to kind of treat, if you do that, if you capitalize the number, put a PE ratio on it or something, it's as if that expense is going to be there forever. And in reality, you're probably not going to spend that same amount forever. It's going to naturally trend down. So that's a sort of interesting kind of thing, which is different from if they had debt or something like that.
Mm-hmm. And do you think it's safe when it comes to the overall industry?
It's a good question. The issues there have to do with competitive things. So they have customer concentration, and the biggest risk, I guess people would say, is smart home stuff. So issues that you would have from companies like Apple, Google, Amazon with something like Alexa or something like that. Yeah. Causing problems for them. I don't know how likely that is, because the truth is that this company's products will probably work with all that stuff. Yeah. Rather than that, those companies intending to replace that. Yeah. I mean, I don't, so, so I don't know how serious that risk is actually over time. Mm-hmm. Yeah.
And then when it comes to it being cheap, yeah, you think it's cheap relative, obviously, towards...
It's cheap. Yeah. Yeah, it's cheap. And it's very high quality. Mm-hmm. Now, I don't know that it will grow. I looked at some things and would say that in general, lots of pieces of the company haven't really grown in probably about 20 years or so. Yeah.
Got it. Cool. Next one's an interesting one, because we're actually going to purchase this for the managed accounts. Okay. And then something happened where we couldn't do it. Okay. And that's Pendrell, PCOA. and your initial interest was 90%, which is technically 100%, right? It's very close. That means you wanted to buy it. Let's just say that.
True.
Yeah.
I think we'll see as we go through this that I haven't given 100% to anything yet. I believe that's true. So Pendrell was a company that I wanted to buy for the managed accounts. It was at that time, the company was going dark. It was a cash shell. It was all that was left of it, with very big net operating loss carry forwards, which means that they would be able to not pay taxes on a lot of income that they would have.
Yes.
We have a big comment thread on the website about people where there was some confusion about things where I think some people wondered if they'd be able to use the net operating loss carry forwards. And I think the confusion that people had is a company that has net operating loss carry forwards can't really be taken over by another company. But it's very easy for a company that already has those losses to buy something else and then to pay less in taxes because of that. And so, as a result, they would get more value out of whatever they would buy than someone who pays 100% of the taxes. And their losses had to do with a very big... this was once a very big company, actually, in a different form, and it lost a very large amount of money. And these net operating loss carry forwards wouldn't expire for a long time, a lot of them. So I sort of talked about what they could buy with the cash that they had. They weren't burning cash at the time. They were producing some income from patents that they had. And they were going dark. And so I figured that they would probably go dark. They would eventually buy something, and the company would be worth quite a bit. At the time, you could buy this stock, at the time I wrote it up, for less than its net cash. And so that means you were putting no value on the net operating loss carry forwards, and you're putting no... so the tax savings that it would have, a big tax shield, and you were putting no value on the fact that it had patents too. So it was a really good deal that way. The company, though, did a reverse stock split. Yeah. A very big one. And I think it raised the price of the stock, what was it, to $170,000 a share or something?
It was a lot, yeah.
Yeah.
Where it just became, we wouldn't even touch it. Honestly.
Right, so we have managed accounts, not a fund. So the issue there is a fund that buys illiquid stocks might be able to buy, say, 5 shares or something if it's investing if it's investing $500,000 or $1 million or something of the fund's money. But in a managed account, obviously the problem that you have is that for individual clients you can't buy $100,000 worth of stock. In those increments, you can't buy in between.
Why do you think that they did the reverse split?
It's a way of going private, basically.
Yeah.
So there's a
make it more illiquid. Yeah.
So I talked a little bit about the management there. The major shareholder is someone who...
I was going to say, didn't they have kind of a bad rep?
I don't know about that.
What was the rep for them? It wasn't bad?
I talked a little bit about it. I mean, they brought in someone eventually who I had looked at 2 other companies that he'd been involved with in the past. I would say I'm not surprised that they basically they went dark and did a reverse stock split. I think some people, if they had an issue with it, were that they were involved with stocks that went dark or did things like that. I don't think that in terms of the returns that the stocks had or anything like that, they were bad, though. No.
Okay, cool.
And the major shareholder was at one time a billionaire. I don't know if he lost enough money that he's no longer a billionaire, but yeah. So there was a major shareholder that owned, I forget if it was 60% or something, a very big part of the company.
More than half.
Yeah.
Interesting. Next one is a stock that we own for the managed accounts. I don't think we've talked about it since we talked with our friend Nate Tobick, but that's KEWL, KEWL, KEWL Land Association, and your initial interest was 90%, and we purchased it probably at the beginning of the managed account, so probably back in like July or sometime around there. I'm not sure. And then we actually bought more of it as well as the stock has gone down.
As the stock went down, increased the amount in it by a lot.
Yeah.
So
did you ever think you would learn a lot about timber?
Yeah. So this is a timber company.
Yeah.
And the write-up focuses a lot on returns in timberland and things like that, and also sort of whether timberland is cheaper at the moment than the S&P 500 or something like that cyclically.
Yeah.
So over a very long period of time in the 20th century, Timbers performed pretty similarly to the S&P 500, but some of that was during a period of really high inflation. And I thought that timber was generally less overvalued than stocks, and part of that may be because it's tied to housing stuff.
Sure.
So over the last 10 years or so, it hadn't really appreciated much in price as compared to stocks that had. And then the company was selling somewhat below the appraised value of its timber, of its timberland.
And there was obviously a clear catalyst for the company, which is what also drew you to it, because for value realization, I guess you could say.
Right. So I felt that the company maybe hadn't been run to maximize shareholder value, let's say. Mm-hmm. So the board that had been there previously the members of the board didn't really own stock in the company, didn't own a significant amount of stock. And they certainly hadn't been compensated using stock at all, which is unusual for a public company. So the board had much less interest from a selfish perspective, whatever they were doing or not, in terms of just the incentives. They had far less incentives than most public company boards have, and most public company executives have, to increase the share price. Mm-hmm. And the biggest shareholder of the company, which is a hedge fund, and at that time owned about a quarter of the company, I think, decided to run a slate of directors to try to take over the board, to get a majority of the board. And they won.
Yeah.
And actually the company there, the hedge fund, is one that's featured in the Big Short.
Cornwall Capital.
Yeah, that's right.
Jamie, forget his last name.
May, is it?
Yeah, Jamie May. But what's interesting about the situation is that they've been invested in the company for how long? I mean, more than 10 years, right?
I think 10 years, yeah.
And I don't think they haven't made money.
No.
So, I mean, like, you could kind of see there's a lot of catalyst happening, I think, for them to kind of try make money on it. Yeah.
Yeah, and I think the stock, it's interesting because we talked, I think, like we said, we talked a little bit with Nate about it, and a lot of value investors and microcap value people talk about it. It's one of those things you'll hear people talk about certain land companies, and we may talk about some of them now. Land companies and things that are involved with water and things like that get a lot of attention from certain.
A lot of people don't like them.
Ones.
Yeah, but like they call them like it's a land bank that there's no nothing to really realize it. Yeah,
right.
It's kind of like a value, not a value trap, but just nothing to be created.
So I certainly knew about this company I probably looked at it 10 years ago. But until this last year, I did not think it was cheap. Mm-hmm. I thought it was somewhat cheap when I wrote it up. And I think it's very cheap now. And so that's why we bought more over time. At the time I wrote it up, I think that I said something like I didn't think it could be worth less than like $102 a share or something. And we had someone else on the website say that he thought it was worth like $117 or something. And this would have been around the time of the board, the proxy battle.
Yeah.
And since then, it declined from 100 something to like 70.
Yeah, it's currently at $70.
Yeah. And it declined pretty consistently going down that way.
You think it's a lot of the board?
People have asked if that's true.
But you said that a lot of the old board members, they didn't really own stock.
Yeah, so it doesn't move on a lot of volume. I would say that it's probably a lack of interest from people. There's a lot of excitement when there's actually the battle with the board and stuff, and people have that catalyst. And then over time, as it declines, there's not a lot of interest. Mm-hmm. Remember that it's this is not really a dark stock, but it is a stock that doesn't file with the SEC.
Yeah.
So I would say the difference is it does have pretty extensive press releases every quarter, and it has it does that appraisal thing, so it has sort of an annual report to shareholders, but it's not like what you would find in a 10K. And historically, every 3 years it had done an appraisal of the land. I mean, we didn't talk all about this, but there were a bunch of things that I thought suggested that the previous board, that the stock might have been worth more than people thought. For example, with the previous board, they came out and said that they had more timber on their land than they thought they did, because they had been using in the appraisals that they had done a model which suggested how much timber they had, instead of having a timber cruise where they actually did some sampling of counting how many trees they had and things like that for a specific area, and then extrapolating from that. And they got a loan from, I forget if it might have been a company related to MetLife. And when they did that, I think because of that, they had to have it. That's not exactly what the board said, but that's my impression. And so because of that, the fact that they wouldn't have known exactly, not just exactly, but how much they missed by, it wasn't like 5%. It was a significant amount difference. And so some things about that, and they have some mineral rights, they have some other things. And when they've had the change in the new board, they've made some, if you look at what they've done, they've made some things where they've done some sales of land that isn't that valuable maybe to the government, or that they've done things where they've given certain rights to different, usually it's related to the government, but sometimes it's other things. I think that they've sort of monetized it better that way.
And when you think about how safe the company is, which is obviously one of your filters, right. I mean, what do? They cut down the timber and they sort of harvest it, and you know, it grows back. Yeah. So interesting business. Yeah, it's an interesting business, and it's now cheap, and I think historically it has been it's a good enough business. It depends. The issue also is like how much is eaten up by corporate costs and things like that. That was a pretty large board. It's not a very big company, so there are issues with how much like corporate costs eat into the value of the timber, right? But just ownership of that many acres of timber is a pretty good investment. Yeah, I would agree. And you did talk about in the article how you would say that you would think this stock would do better than the S&P 500 over the next 10 years. Or something like that. Yeah, I think timber as an asset class in general. Timber as an asset class, I think would do as well or better. And then certainly I thought that the stock was a little cheap compared to its appraisal value. Yeah. Whereas the S&P at the time, now remember the S&P has gone down, I don't know, 10% or something since I wrote that up. Yeah. But so stocks I felt were a little overvalued, whereas timber was pretty fairly valued or something historically. Yeah. Cool. Next one, Maui Land and Pineapple. Okay. Ticker MLP. Your initial interest was 80%, and it's currently trading at $10.31. Yeah, and this is something that we owned for the managed accounts in a small amount, though. Nothing like KEWL. Yeah. So this was probably... so we probably had, at the time that we owned it, 5 or 6 positions, and this would have been the number 5 or 6th position. Yeah, the last. Yeah. It was never one that moved up beyond that. So it was the most marginal one that way. Owns land in Hawaii. It had developed a resort. So obviously from the name you can tell that it was once a pineapple producer. Yeah. But, and that was 100 years ago or so. Most of the land is at prices that it got in the early 1900s through like World War I era. Yeah, very cheap. Yeah. We didn't mention that with KEWL, that their land is mostly land that they got actually from the government, and is at prices that are over 100 years old. In both cases, with both companies, they're held on the books at prices that are 100 years or more. So their book values are unrealistic, obviously. So Maui Land and Pineapple has a bunch of acres that some people get excited about. Thousands and thousands of acres, but that's not the part that interests me. The part that interests me is it has, I don't remember the exact number, 800, 900 acres, something like that. That is resort land, and that's the part of the resort that they built a long time ago, a master plan community that they didn't fill in. And so that land is very valuable, and we talked a little bit about that. I think in the write-up I said something along the lines of... I mean, realistically, that land's probably worth $500,000 an acre. Yeah, probably. Yeah. I mean, I remember when we talked to people, they said if you could get anything under $500,000, that's a steal. Yeah. Yeah. So that's in, I guess, West Maui. It's West Maui, which is the finest real estate, if not in I mean, definitely in Hawaii, but probably in the country. I mean, it's very, very nice real estate. Yeah. So, and has all the approvals that it would need to be developed, which is different from a lot of things on Maui. A lot of the stocks that you can find that own public companies that have some ownership of land
on Maui have all sorts of things that it would take to fight for through different groups that might want it for conservation purposes and things like that, to get planning permission for it. So, and this is basically part of an existing resort. It's right there. A lot of it has excellent views and things because it's basically on a
every view is ocean proof.
Yeah, exactly.
Or ocean viewable. Yeah,
right. Because you're basically on a slope looking out to the from the mountain out to the water. So the value of the land is excellent. It's something that's likely to hold its value. I think I talked about how over the decades the price of that land appreciated at a much better increase than you would have on things like on the mainland. And you can see on maps of Maui and what is not developed and land that's altogether there, blocks of land that are left that this company has, one of the biggest and most valuable pieces that are left on Maui. It is something that doesn't have much of a catalyst and doesn't have a lot of capital, which are the two issues that it has. So if it intends to develop land itself, it needs to borrow to be able to do that, or it needs to sell off some land to be able to invest in the development itself. It had said it doesn't give much information at all. It is not a dark stock. It's a public company that files with the SEC, but it gives less information than some of the companies that don't file with the SEC. So like it gives less information than KEWL does. It has plans over like 20 years or something to develop the rest of the land, and it took about 20 years to develop the first phase of the development that it did. To give you an idea of what it originally did in the 70s through the 90s, it is condos, a couple golf courses, one of which is a big PGA course that I think every year they play on. There's I think a Ritz-Carlton there that was part of the original development, and some things like that.
Yeah.
So it's very interesting land, very interesting value. It's obviously the stock is cheaper than the value of the land would be. If someone could buy the stock to have control of all that land and have the capital to develop it themselves, then they could make money. There is a majority shareholder, though, who owns a lot of land, former CEO, chairman, founder, whatever, of AOL.
Yeah.
Yeah. Who owns another company on
I was going to say,
Hawaii,
he's
too.
also involved in another company in Hawaii,
Yeah.
right? Yeah.
He's probably one of the bigger landowners in Hawaii. So I think the question is, how long would it take to get monetization of the asset, and also how much capital the company would have to put in and at what price, because they really just have a small amount of cash. 10 or so years ago, they ran into trouble. I don't remember if it was after 2006, 2008, in that range of years. They ran into some trouble, which forced them to, in terms of capital, which forced them to sell off some assets that were pretty valuable there. So that's always something that could happen. So they did sell off some. They had some land that they sold off, and some things, buildings and things that they had already there that they had once owned and had to sell off. So that's always a danger. Like I said, they might have to sell things to develop other things, or they might have to borrow, and that's difficult to borrow a lot of money to do that. If you look at what the estimated development cost would be of that land, it's potentially quite a bit larger than their market cap. So that's the issue that you run into there. But obviously, to another owner buying the entire company or something, it would be worth a lot.
Yeah. Cool.
So.
Next one, and this is one that you wrote about the other day, like we referenced, Green Brick Partners, GRBK, and your initial interest was 60%.
Okay.
Little bit of a background. Green Brick Partners, they did a reverse merger. It used to be a shell company. I think the name was Biofuels, something like that.
Yeah, it was ethanol.
Yeah, ethanol. And Greenlight teamed up with this guy, Jim Brickman, hence the name Green Brick, and they did a reverse merger, and Jim Brickman is the CEO of Green Brick Partners, their home builder company here in Plano, Texas.
Yeah, they're headquartered
past their HQ.
And a lot of their lots for what they plan to develop are actually not just in Plano, but are particularly Plano or Frisco, very close to where I live. Yeah.
And they operate in the DFW area and Atlanta, and then also Colorado, I believe, as well.
Yeah, and they also Florida now.
Yeah.
But the Florida and the Colorado are really insignificant. It's basically half Atlanta and half DFW.
And it was also interesting because Dan Loeb's Third Point also participated via a rights offering, and then I think they sold off their whole position. Yeah,
last year.
Yeah.
So originally, the way they did the reverse merger is you mentioned Greenlight, which is David Einhorn, Greenlight and Third Point, which is Dan Loeb, invested in the company by basically Greenlight did a loan to them, and then they immediately bought shares to pay for that loan, to pay off that loan. So basically, it was a way of having, I guess it would have been high 40% to Greenlight of the company, and then some amount, 10% or something to Third Point. Together, they probably had 60% of the company or something like that. Whereas the founder, who you mentioned, low single digits percent, I forget, 3-5%, something in that neighborhood.
It was interesting as well. If you've read "Fooling Some of the People All the Time," I think that's David Einhorn's book. Brickman's actually in there because he was a part of. I think he reached out to David when David was shorting. Was it Allied Capital? Was that what that company was? That business, and I think he was also short this company as well. So I think that's how they built their relationship. Jim Brickman was actually in retirement because I remember I read a blog post by Brickman that was from a long time ago, and he was obviously joking around, but he said, "Thank you to Allied Capital for keeping me off the golf course. Like, this is way more interesting, whatever." Because he was also involved in shorting the company. Yeah,
if you read about it, it's a little complicated because you have the predecessor company, which is now treated as the company that it is, which is not, because of the way that a reverse merger works in this kind of situation. Some of the things that they're referring to in the 10K have to do with the ethanol company, and some of the things have to do treating it as if this home building company was the company that was there that whole time. Anyway, the point is, you definitely get the impression from reading the company's filings that Einhorn and Brickman knew each other going back more than 10 years, I would say. Sometime in the mid-2000s, something in that area.
Which is around then,
I definitely got the impression. So, and like you said, he basically came out of retirement.
He chose to
I think Dan was maybe 66, 60, somewhere in his 60s.
Yeah, I know he ran a successful similar operation, probably on a much smaller scale, but I know he was pretty successful beforehand.
Yeah, so the structure of the company is a little different. So the reason for being interested in it is because I know what land it owns. Okay, so about half of the land is in DFW, and I, in particular, like, you can read articles and news things and stuff around here that you know what land they own, what lots. And so they give names of the communities and things, and you can recognize the names of the communities and the streets and things like that because we live around here. So we have a good idea of that. And Dallas and Atlanta are particularly sort of good job markets.
They're two of the hottest growing metropolitan areas in the country.
Dallas right now statistically is the most, and Atlanta would be in the top 5. And they own better locations, like I said. It's not just that they're in the Dallas area, but they're particularly, because I know where the land is, they're in particularly the better towns and some of the better locations, and they're sort of locations that are a lot of the land has already been developed around them. Okay, so it's just the kind of thing where you'd have more faith, but that's only half the company because I don't know anything about the Atlanta part. I don't know anything about Atlanta. But I have an idea about the value of the assets and how good they are on the Dallas-Fort Worth part of it. So that's about half of the business. The structure of the company is interesting. So it only owns half of the home builders. So the way that it's structured, and this is a little different, like you mentioned Colorado and I mentioned Florida, that stuff, which will be becoming significant in the next few years, I think, it has a different ownership structure where they own 80% of one, they're going to own 100% of something. They're starting their own home builder for the first time ever in the Dallas-Fort Worth area where they'll own 100% of it. But right now, all of the significant assets work this way. They own 50% of the home builder, they have 51% of the votes, and they have 2/3 of the board. So they're companies that they control while only owning half of them. But the significant part of it is because of their control of it, they provide the capital and the land to these 50% owned home builders. So it's a little interesting, and they talked about this on an earnings call recently where analysts were talking to them sort of as if they are just a home builder. But the truth is that they have 100% of the land development operations. You as a shareholder buying into Green Brick have a 100% interest in the early stages of it, which is the land part of it. But then you only have a 50% economic interest in the actual home building operation. So things like increases in labor costs and stuff that affect the home building operation or might reduce the earnings of that don't affect you in the land part. So you have really 2/3 of your economic value in the company or so, or between 2/3 and 3/4 is land stuff, really. And so it has to do with the value of the land and how much it'll go up or down over time. It's difficult to judge because for the last 7 years, you've had constant price appreciation, both in Atlanta and in Dallas. Recently, the prices have been going up like 5% a year on land. So it's a very interesting structure. I talk a lot about the structure there. They also weren't paying taxes to the same extent as a company normally would because of their history with the ethanol company that obviously lost money. So they had net operating loss carryforwards. That will go away, and they'll just be a company paying taxes like anyone else because they're earning so much now that I expect that to go away in like a year.
Why only 60% interest level?
Only a 60% interest level because it's a home builder. Because I don't think it's remarkably cheap.
Mm-hmm. It was trading, I think, at like what, $11, and now it's around $8.
When Third Point announced they were going to do their offering, which was their way of getting out of the stock, it was $12, and then it went below $8. And I think when I wrote it up, it was about $8. I don't think it's very complicated in terms of the accounting. So if you look at the accounting, it would have something like $9 a share in book value.
Yeah.
And it would have something like $13 a share or so in land inventory because it uses leverage like almost all home builders do. It has less debt to capital than most home builders, so it has room to expand that. It could probably double the amount of debt that it has and still be within sort of the normal range for a home builder. And so it's growing pretty fast recently, but if it does grow really fast, it'll do so by increasing its debt. Returns on capital aren't that high in this business, and they're really cyclical, so it's hard to judge. Their returns lately have been good. Like they've had, I think, a 17% pre-tax, so like a 17% EBITDA return, which then you do the taxes and stuff. You're still talking about low double digits type returns on capital. Mm-hmm. And then they use some leverage, so your return on equity can be even higher than that. But the problem is what happens in bust years, right? So, which is interesting. So we're maybe halfway between the bottom of the number of housing starts in these markets and the top when you had your peak in each of these, which was very high. And so it's an interesting question about interest rates going up and things like that, how much that affects the land prices.
I know someone that he is a home builder here in Dallas, and I think he had like 200 or 300 lots, and he's selling off everything. Mm-hmm. He's very bearish on real estate in general, but I mean, certainly here. I got to get him to come on the podcast to talk about real estate. Yeah. And
they talked a lot about the competition that they're facing recently.
Yeah.
And you have significantly increasing interest. This is the company that will be most harmed by interest rate increases. So the reason why interest rate increases are so bad for home builders is a few things. One, the value of land tends to move opposite of interest rates. So increasing interest rates tends to pull down the price of land, and land's very important to this company. Two, the companies borrow money, and they generally have floating interest rates of some sort. So this one's tied to prime rate minus a little bit. And then three, you also have, if you are raising interest rates because of inflation, the worst thing to happen to home builders is inflation pressure. And you had, like in the 70s, you actually had margins go to nothing in home building because you had really high rates of inflation in the 70s and early 80s. and you have really high wage increases and raw material increases and things, and you can't pass that on. You can't increase the price of your homes as quickly as you can, things like labor and stuff like that. So home builders benefit a lot from really, really low interest rates and really, really low wages. So really high home prices combined with really low wages are what's really very good for home builders.
Yeah.
So they had the last 7 years, I would say, is like the best period for them in terms of how much better it gets each year. That way you had very low interest rates, but you did not have accelerating inflation, and yet you had land going up faster than wages, right? So land prices going up faster than wages is really good for them. So those are the concerns. I like the company overall. It's hard to say, though, because it's sort of speculative. There's more of a land aspect to this, and it's really hard to tell if they're a better business than other home builders, or if it's just that they're in certain markets and during a certain period of time. So they were in Dallas and Atlanta, and we only have the last, the record that we have is only the period of expansion in housing. So those are the hard parts about it. I would look seriously at the company if it got down to like $6.50.
That would be
a price.
That'd be pretty crazy. I mean, I remember I looked at the company 4 years ago now ish.
Yeah,
maybe 3.5 years ago, and it was around like $5.30.
Yeah,
I mean the company's come so far. Fundamentally, it's improved so much since then. So it'd be crazy if it got down to that area. Yeah,
you have to be careful looking at the company because the business model is different from other companies, and it's possible that the sort of structure that they have is better for them than it is for their home building partners because they're providing the land and the capital. And they talk about their targeted internal rates of return, which are very high for like the loans and the
low 20 or in that area, very high for that.
It's like 13 to 20% or something. And for the land that they provide to the home builders that they control, and for the capital that they provide to. So they're targeting good rates there. But the concerning thing about it is just the cyclicality of it. It's hard to tell if it's really a better business. So my answer was, is it safe? I thought it's safe enough, but not necessarily great. It's adequate, but it's not excellent safety. And I thought the quality is adequate, but not excellent. And I thought it's cheap. It is cheap. And I said that, that it is cheap. Yeah.
Cool. Last one we have to go over. Another one that we talked about with our friend Nate Tobit, because this was a oddball stock.
Okay.
Vulcan International, ticker VULC, and your interest level was 90%, and it's currently trading at $123.
This is one that you'll, listening, have to just go and look at whatever the latest information from the company is.
Yeah.
Because this is a dark stock.
Yeah, they don't file like anything.
Right. They don't file anything. In fact, they tried to...
Don't they make you sign an NDA?
You can read. Go to Oddball Stocks or go on Google.
He owns a single share.
Vulcan International Oddball Stocks or something like that, and you might be able to find things that times he's written up. They're truly dark stock, and they kind of try to downplay or not be too public about what things they own. They own a portfolio of bank stocks that's a good portfolio of bank stocks. So you have to look at the company yourself because they talked about liquidating, and so you have to follow up on that. Because it's a dark stock, you won't get a lot of information from that. They'll just say that we're planning to do this and what stages that would be and how they would liquidate and everything. So be careful about the price and whether it's going to liquidate or not. So you have to go probably to otcmarkets.com, find any news that they have on it, look at the price. That's the best place to start, is probably in otcmarkets.com. You may want to buy like a share or something. That's a good way to track a stock like this anyway. And actually that's why I first was looking into the company, was to use it as a stock to track when we were first starting the managed accounts. It was actually before we were going to start the managed accounts. What stocks would I want to own a piece of to be able to track things? Truly dark stocks.
Sure.
And Vulcan is a truly dark stock. So, but maybe I should talk more about like the lessons that you can learn from looking at this kind of, like finding this kind of company. So, written up at Oddball Stocks plenty of times. It's the kind of thing that people don't own or something because they're afraid that you'll never get value out of it. But the interesting thing here is because it owned stocks, the value of the company was going up all the time that way. So like that's also the story with like the timberland company that we talked about. Although I might not have felt the board was going to do anything to realize the value of the timber, while the stock went nowhere for 10 years, the timber was still growing. There was some inflation, so the value of the timber is going up over time, those sorts of things.
Yeah.
So you want to find something like that, or like we talked about Maui land and pineapple. The value of land on Maui is more valuable now than it was when the stock was at similar prices 15 or 20 years ago or something. So you want companies like that and not more operating companies where if they're a little negligent, things aren't going that great. So a company like this, you could tell that they own stocks that were probably going up in value all the time. You could look lots of places online, whether it was oddball stocks or on message boards and things from people who had some information about the company. And in general, the company is like some dark stocks where a company might be dark and might not be commenting on things for a few reasons. One is that they just don't care or something like that. Another one is that they don't want a lot of people to discover the stock and realize what sorts of things they own and pressure them to do something like liquidate. And the other one is because they want to sort of rob the company of its assets and sort of enrich themselves and things like that. And so you want to look at the difference between those two sorts of situations. Is the company going dark and everything because it wants to not have shareholders looking at it because they might want to be paying themselves high salaries and things like that? Or are they doing it more because they might have valuable assets there? So when we talked about like Pendrell, that was one that had some examples of some signs of something that sort of wanted to go private, basically go dark and then do a reverse split so that you're basically pushing out the smaller shareholders, right? That's a good sign. If a company basically wants to sort of go private and it has a big shareholder in it and things like that, that's a pretty good sign that they're doing it because there are assets there that are valuable. And so you want to look into it, see if there are assets that are valuable, and see where your interests are aligned with the big owners and things like that. And so that would be the example there with Vulcan. So you could learn about it, read about it, about what Nate wrote about it, and try to look online for other examples of that. There are other companies out there that are like that in some ways, and it's sort of a better thing to go look for them. Right now, Vulcan as a stock might not be that great because the news had already come out after I wrote about it and stuff. Actually, while I was writing about it, I think the news came out of them planning to liquidate. And once it becomes sort of to dissolve the company, and once it becomes sort of a catalyst in this kind of stock, usually there's not as much value. Although if they don't do anything for a little while, sometimes people can get bored and that opportunity can come back. Mm-hmm. But often the best time is to buy these stocks where there's a ton of value and yet no one sees a catalyst yet. Yeah. And then sometimes the catalyst does happen. Mm-hmm. Yeah.
Cool. I think that was a great first episode. Mm-hmm. Hit on everything we want to talk about.
Yep.
Perfect. Well, we hope everybody enjoyed it. Thank you so much for tuning in. So we have some housekeeping stuff because I didn't really talk about in the beginning. So the website's a little bit different now if you haven't been to it. As I referenced, there are a bunch of free posts on there. I mean, free content on there now. And you could become a free member. All it requires is an email. Yes. And what they'll also give you is a weekly memo from Geoff.
Right, which is the only thing you'll get from me if you're a free member.
Yeah, so and of course, if you're a paid member, you still get that free memo as well.
Right. So we should explain that. So the free membership, which you can get by just giving your email, will give you a weekly memo from me, which will include links to the content, any new content on the site.
That's free.
That's free. That you have access to.
And it's an investing principle. So pretty much the same if you've been on that list.
Right. So it's a general investing principle memo that you'll get from me. And then you'll have links to stock write-ups and things by people who are not me. Yeah. If you're a free member, what you get is links to content on the site that I did not write. Mm-hmm. So the site has, I don't know exactly, but maybe recently it's probably something like 50-50 between things that I write and things that other people write. Yeah. And if you're a free member, what you're going to get is the access to the things that other people write up. Mm-hmm. If you're a premium member, you pay, then you will get a something weekly from me that is not a memo, which we said you'll also get access to the memo, but you will get it's watch list.
Yeah, watch list that shows your research pipeline and stuff that you're looking at, the price and everything that you're interested in. I was pretty impressed when I saw that today. I was like, wow, this looks great.
So like for instance, on that one that was just most recently sent out, number one was GreenBrick.
Yeah.
But then after that, there's another stock on it, which in all likelihood will be the stock I write up next week.
Yes.
Right. So, and you basically should expect that you'll get that on Mondays. And also, they will reference content. They'll have links to whatever content came up in the last week, between the 2 Mondays. Mm-hmm. So you can now go to the site. If you want to be a free member, you just put in your email address. And if you want to be a paid member, there's a place that you can go to join.
It's a good sales pitch. Good job out of you.
And the memo this week was about a stock watch list.
Yeah.
Basically how I do my stock watch list.
Yeah.
So the premium members got the actual watch list, whereas the free members got me talking about the way that I do it. And like I talked about how I just have sort of 3 lists and things like that and why I do that.
That is correct. And we have lots of big goals for Focus Compounding this year.
Okay.
And to improve the podcast and keep the content as good as it can be. I think the schedule is going to be, we are going to try having like 1 week you and I are together, and then the week after that, we're going to try bringing on individuals. I think that got a lot of people have emailed in and said that they really enjoy, bringing on guests and not just stock market as well. I mean, it could be entrepreneurs or, whatever, but more so obviously stock market based, because that's a lot of our listenership. So other than that, thank you so much to everybody for tuning in with us. If you do want to get access to those memos we referenced, go to focuscompounding.com. If you want to follow me on Twitter, I have been posting a lot of content again on Twitter. I kind of took a break into the end of the year, but you can follow me at @focusedcompound. And other than that, thank you so much for listening in. If you want to support Geoff and I, of course, this is free. Feel free to give us a rating and review on iTunes. That helps us out so much, and we definitely appreciate that. It helps spread the word. So other than that, thank you so much to everybody. Have a great week. We'll see you next week. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.